Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the Pink CYDVF, and on Frankfurt C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Victor Adair, co-founder of the Polar Futures Group. He's Senior Vice President and Derivatives Portfolio Manager for PI Financial in Vancouver. His website, PolarFuturesGroup.com. Welcome back to the show, Victor.
Well, thank you, Jim. Good to be with you.
The major American markets have been on a tear of late, but in just the last few days, we've seen a down dip. Before we get into that, can you maybe give us your personal overview of what's happening with the markets?
Jim, I think my call it my big picture view, and I've said this for a number of years, is that it's all about the central banks. For years, the central banks have kept interest rates really low. Real rates are, at zero or negative. And, that was probably the right thing to do, following the financial crash in 08, 09. But certainly since then, the pumping money into the system that the central banks have done has caused distortions, to say the least. Like, say, in market pricing, maybe sent the wrong signals to people because of the distortions. We had asset inflation, in other words, particularly the stock market, but also in the real estate market, but not wage inflation. So that has certainly contributed to what would be called, global wealth inequality, and that's probably one of the rising social problems that we've got in the world that, may come back to bite us at some point in time, if not already. Low volatility. And here's another one too, and there's a thinking in the market, I believe, that the Fed's got your back. The Fed will not allow the market to crash. If the market takes a big dip, they'll be right there with the blanket, to save you. So I think that the central banks, through what they've done, have really distorted it. Yet, I wonder sometimes, at the heart of it, what has motivated them to do what they do? I don't believe they're purposefully evil people. Well, that'd just be too scary to imagine that. But perhaps, like big government, they believed they knew better than the little people, so this is what they did. But as a trader, I have to say to myself, it is what it is. The market is where it is. I can trade price, even if the price is maybe not all that reflective of the real world, but it is what it is. We have had a huge rally in the stock markets. People around the world have become, I should say, I think, increasingly willing to make riskier and riskier moves with their capital. The old technical analyst at Merrill Lynch, Bob Farrell, one of his rules was the public buys the most at the top of a market and the least at the bottom. So we've had what I would call a risk-on market. That's the sentiment in market, and how that shows up across different asset classes means, and particularly in the last month or two or so, but it's longer than that. This risk-on attitude says basically buy stocks, and the riskier the better. Go out into emerging markets, go out invest in countries you couldn't find on the globe. Sell bonds, sell the U.S. dollar, and maybe buy some currencies. Given that I should say currencies, but commodities. Given that commodities might be viewed as a real cheap asset class relative to everything else. So a big picture, just to finish that up, looking ahead, I think there's maybe two things I want to touch on. One was 2017 was a record year for central banks pushing money into the markets. 2018 and 19, you're going to see a whole lot less money come into the market. I mean, we're talking multiple hundreds of billions of dollars in size here. with the Fed tapering and the ECB, apparently going to start tapering the money they put into the markets, taking back some of that money. And at the same time, governments are going to be looking to borrow more money. They're going to be offering more money into more bonds into the market. Somebody's going to have to buy those things, and I think that runs a risk of pushing interest rates higher. And the real wild card here is we've got a whole new Fed. Powell will be the chairman of the Fed going forward from here. Today was Janet's last day. And I think maybe the consensus expectation is that Powell is going to be just like her. And if you read some of the things that he said over the past couple of years, it'd be hard to believe that. Now, perhaps, once you're sitting in the chairman's seat, you change a bit. It's like, when you're in government and you're in the opposition, you can make all kinds of claims, but you don't have to do anything. But if you ever get voted into office, you got to own the job. U.S. financial conditions are at 25-year lows here with, the stock market being so strong, the weak U.S. dollar that could provide cover for Powell and the new Fed to raise interest rates more this year than what the market expects. So that's one of the things I'm looking at. Certainly bullish sentiment in the market has been extremely strong here, and I'm inclined to think it's overdone just on the basis of positioning risk. So that's my answer.
We'll have more with Victor Adair right after the break.
MGX Minerals is revolutionizing the new energy economy with patented lithium extraction technology, replacing traditional solar evaporation using low-cost, low-energy nanofiltration. The first system of this paradigm shift technology is currently being commissioned. MGX Minerals trades on the CSE, symbol XMG, the OTCQB, symbol MGXMF, and Frankfurt, symbol 1MG. For more information, visit our website, mgxminerals.com.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Rideout Shear Zone in Ontario, with grab samples running as high as 32 grams per ton gold. A follow-up drill program to test numerous targets located by recent groundwork is planned for early 2018. Please visit our website at rmroyalty.com.
Welcome back. We're speaking with Victor Adair. Victor, really, with the U.S. stock market advancing year after year, finally, after 6 weeks of constant advances, they had 2 days, Monday and Tuesday, where the market was down. Is that a hint that we might be seeing a correction happen, or one's likely to happen in the near future?
Real short term, Jim, I was very interested in how the market behaved Friday of last week. Let's see, what date was that? That would be the 26th of January. It just melted up into the close. It just took off like a rocket. Like there were no sellers, and the market just had a huge advance. And then Sunday afternoon, we opened lower, and Monday and Tuesday lower, and here again today lower, although we haven't got to the close yet. But I think very short term, it looks like we had this blow off top, and the market's backing up a bit. That's what I think here in the very short term. A little longer term, I say to myself, who's buying this market? I mean, and why? And prices have been going up. I think maybe back in 2009, 10, 13, whatever, there may have been room for value buyers to come in and buy the market. But clearly, lately here, the market has been a momentum market, a sentiment-driven market to the upside. But that doesn't mean that, it's over. I mean, there are long-term buyers out there, that need to generate returns, pension funds, sovereign wealth funds, that sort of thing. Swiss National Bank, for those people that like to smile. Then there's TINA. There is no alternative in a world of ultra-low interest rates. People come into the stock market. But then as stocks go higher, as momentum goes to the upside, momentum in a way creates momentum. And people become more and more risky. You buy something, it goes up, you're rewarded. It's like the mouse going after the cheese in the maze. You do it again. Then we have all of the ETFs and passive investing, where money is just pouring into the market because, gee whiz, Charlie, it's a sure thing. You know, I read something the other day that just really gave me a smile, and that was that, you know, as the world becomes more aggressive this way or more willing to take on risk, that rational thinking is a handicap. You know, as I said earlier, the public buys the most of the top and the least of the bottom. I think that's what's happening right now. I think even the bulls, however, are expecting that, you know, it'd be okay to have a little correction, be healthy. You know, we had a jump up in volatility. I'm expecting at least a little correction here in the short term, and then maybe it's the start of something bigger.
Now, I recall 2 years ago we had the January 25th Black Friday where we had a big drop. That correction was what, 10%?
Was it that much?
Or even that much?
That's not coming to my mind right at the moment, but yeah, we've had corrections. I mean, I sat through the one in October 19th, 1987, couldn't believe what was happening when the Dow Jones fell 25% in the day. And we've had a number of breaks over the years. We do get them, but there's this, what I call positioning risk, when everything's kind of gone along the way of, we can't do anything other than go higher. You know, it's like the Vancouver real estate market. It just goes up all the time. You know, or the Vancouver Stock Exchange in 1999 when all the mining juniors became .coms. You know, every day it goes higher. When you have that kind of thinking in the market, and I think we're there, it creates an opportunity, not necessarily a necessity, but an opportunity for the market to have a break.
Earlier you talked about how rising interest rates could at least cause a correction in the stock market. Will we get a number of interest rate hikes, and will that program be pulled if there is a major influence on the market driving it down?
Well, put it in perspective. I mean, most of us listening are going to remember the interest rates around the time Paul Volcker came in, and he had 21% prime rates, that sort of thing. We've been in a 35-year downtrend in interest rates, in bond yields. We hit 5,000-year lows, call it that. I'll have to put that in parentheses. Back in the summer of 16, during the Brexit time, we had trillions of dollars of negative yield sovereign debt in the market at that time. So right now, we've got the 10-year Treasury, the U.S. Treasury, at a 2.75% yield. That's a 4-year high. The 2-year is at a 10-year high yield. You know, I think, well, the account that my son Drew manages for me, the Guarded Opportunity Fund, has been short the 10-year Treasury bonds since November. I mean, we put our money where our mouth is. We think interest rates are going higher, and so far we've been right about that. The bears on the interest rate market are going to say, you know, a number of things, but one of them would be, this is the biggest bubble ever, with all the debt outstanding out there, and that people have been sucked into buying this stuff because, you know, the interest rates on bank deposits and so on was so low that the people that own bonds are ultimately going to be left whole in the bag. The bulls are going to say that there is so much debt outstanding in the world that if interest rates rise at all, the increased cost of servicing that debt or paying the interest rate bill is going to kill the economy, and because the economy gets killed, interest rates will fall right back again. You know, and I think also the bulls would point out that this level of debt plus demographics and plus advances in technology contribute to just a continuing path of deflation, deleveraging. So yeah, there's bullish and bearish arguments. Just for us, the past couple of months here, we've been inclined to think that interest rates go higher, and we still hold that view.
We'll have more with Victor Adair right after this.
Aben Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Aben's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at abenresources.com.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com. Welcome back. We're speaking with Victor Adair. Victor, what's your view on what the U.S. dollar is going to do after making a 14-year high a couple of years ago?
Well, Jim, I have done very well being long the U.S. dollar and short other currencies for the past few years, so I know I've developed a bias. And I've traded currencies for more than 40 years, and I'll tell you, I keep reminding myself that the trends in the currency market very often go way further than seems to make any sense. Then they turn on a dime and go the other way. So if there is ever a market where you could say the trend is your friend, it seems like it's the currency markets. Having said all that, I got to tell you, my gut here, I think the U.S. dollar is presently way oversold. Now, that's going to be mainly against the euro currency because it seems, that's the leader, the U.S. Euro cross rate. Other currencies take their cue, from what that is doing. I think that U.S. dollar weakness is part of what I would call a risk-on world where you can take your chances and go out on the risk spectrum. I think a month or two ago we talked about what I called a key turn date on September the 8th. And that was the date when a whole lot of markets turned. At that point, prior to that, the U.S. dollar had been weakening and got higher for a couple of months. What really happened on September 8th was that U.S. short-term interest rates turned higher. And what's been really interesting and really puzzling to me is since, let's say November or so, we have seen the interest rate differential. In other words, the premium that you got for putting your money in U.S. dollars just kept getting greater and greater and greater over what you got if you put your money into euros. Particularly, we're looking at Germany. And I'm thinking, gosh, here the interest rate spread is going one way. It's dollar bullish, but the currency is going the other way. The euro is rallying. Why is that? And I'll tell you, if there's anybody out there that can really figure out the answer to that question, then they'll figure out, what to look for when it stops. I think it's possible that the traders in the world feel as though the European area economic and political problems are of the past now, and that the European Central Bank will actually be more aggressive in raising interest rates going forward than the United States will. And I think we also talked about where I see the euro rising against the Swiss franc, which may be another barometer that markets think, the European problems are history. I'm not sure about that. I'm probably inclined to disagree. But what I see is that we've had massive long positions in the euro. In other words, this huge positioning risk where at all-time record high bullish positions on the euro right now. So if, for some reason, the euro starts to slip, the rally in the U.S. dollar against the euro and against other currencies could be more aggressive as those positions get unwound. Because we're in Canada, let me talk briefly about the Canadian dollar. I've thought it's the weakest of the group of currencies. In other words, if I'm, because of my bias, inclined to be U.S. dollar bullish, I've been doing some shorting of the Canadian dollar. I've been losing money doing that. What I do is I keep my position size real small and I take my losses real quick, but it still doesn't do my ego any good to see that I'm running up a string of losses with Canada. And Canada, by the way, it's not looking at interest rate spreads. It's the same as the German-U.S. interest rate spread. It's not looking at the commodity market like it often does. Canada is kind of a commodity currency. It's not seemingly worried about NAFTA. It's all about the Canadian value here is all about the relative strength or weakness of the U.S. dollar. So as the U.S. dollar remains weak, even Canada, which I think is the runt of the litter, is trading a little higher.
How is the U.S. dollar weakness going to affect the price of gold?
Well, I mean, we've had a rally in the gold price here since the middle of December when, God bless her, Janet Yellen seemed to flash a green light. Say she didn't see any red lights, didn't see any orange lights, and everything took off, particularly in the currency markets. The rally in gold since the middle of December, I think, has been all about, or the flip side of U.S. dollar weakness. The rally in gold, it's so interesting to see this, has happened despite U.S. real interest rates going up. So on U.S. real interest rates, and I use the 5-year tips as a measure of that, are now at the same levels they were back in December of 2015. In December 2015, gold was $1,050 or $300 lower than where it is now. And over time, real interest rates in the dollar have had a big impact on the ups or downs of gold. So here, gold is ignoring that, as it were, and paying attention virtually to the relative weakness of the U.S. dollar. Now, again, in my trading career, I've seen relationships form, and then they don't work anymore. And I also wondered, and here's a little bigger picture thing, if we're seeing some buying in commodities and gold from what I would call macro asset allocators. Think in terms of pension funds, sovereign wealth funds, that sort of thing. One of the commodity indices is called the CRB, the Commodity Research Bureau. That indices is down 75% relative to the stock market from where it was in 2011. In other words, just a ratio, CRB to the stock market. Gold is now 70% cheaper in terms of the S&P 500 than it was back in 2011. So and it's at an 11-year low relative to the S&P. So it's possible another contribution to the rising gold price is people, just to put it really simple, that have made a lot of money in the stock market are saying, let's take some of that money off the table, look around, see what's cheap. Okay, let's buy some commodities. Let's buy some gold.
Before we wrap up, what's going to happen with oil right now? I mean, we're around the $65 mark. This is usually the time of year when we see lows for the price of oil. Can these highs be maintained?
Well, to cut right to the chase, just like the U.S. dollar, I mean, I've had a bias in the crude oil market for the past number of years. I made some good money trading crude from the short side. So, just like a criminal, I go back to the scene of the crime. I look for trading opportunities on the short side. And I missed the rally we had from summer of last year into, say, current times when we went from $42 to $66. There may have been some of this, what I call macro commodity buying in the oil market. People taking money away from the FANG stocks, for instance, and buying the energy sector somehow. Certainly, the weak U.S. dollar has supported higher oil prices. I think there has been a sentiment change in the world in terms of supply, demand, and inventories, feeling as though inventory, the gross supply of oil above ground has shrunk. Demand has picked up, and the balance with supply has gone in favor of the bulls. The cutbacks we've seen from OPEC and non-OPEC. Then on the other side, you could say longer term, OPEC's probably fighting a losing battle with technology. Everything that drives all the fracking and that'll drive all, electric cars and alternative sources of energy and so on. Okay, I told you I'm kind of inclined to think the U.S. dollar is oversold, so maybe the U.S. dollar could do better from here. There is a massive positioning risk in crude oil. In other words, everybody and his dog's got a long position in crude, so if prices start to break, those people throw in the towel and that'll take prices down. We are seeing increased production from certainly some of the non-OPEC countries, and the leader there, obviously, the United States. I own some puts on crude oil. Now, I'm fighting the trend, and because I'm fighting the trend, I'm going to take a risk management position. It's going to be small size, and I'll be gone quick if it's not working. But I'm currently looking for the price of crude. I'm saying to myself, it's overdone. And one last thing on that, maybe the Western Canada Select, our benchmark crude oil, trading at a $28 a barrel discount to WTI, so that works out at current prices to about $37 is what Canadian oil is worth. So if you look on the news and you see WTI is at 66, don't think that people in Alberta that are producing oil are getting 66. And at the same time, because of America producing so much natural gas, they need less of ours, and our natural gas is trading at a really steep discount to the natural gas price that you see quoted on the evening news in New York.
What's the feeling with the BC NDP / Green government putting up more roadblocks to getting the pipeline from Alberta to the ocean?
Well, I mean, that goes right to the heart of the issue. I mean, the reason, or certainly one of the reasons, our Canadian crude is trading at a discount is because there's, let's put it in gross language, we're producing more than we can ship. So the people on the other end, they're going to go, oh, well, these guys are going to have to be, they'll be forced to drop our price. The whole thought of, why don't we just stop exporting oil? We can just leave it all on the ground and we can all, I don't know how we're going to pay for all the tax programs that we have, but that's a political, environmental issue. There are some folks, I can understand that. I can, you can picture the birds all covered with oil, and we all, know those images. But one of the things Canada does is produce commodities. And if we have only one customer and we can't even deliver all the stuff that we produce to that customer, we're going to have lower prices for our goods, and we're going to have less money to pay for everything we want to pay for.
Victor, thank you so much for chatting with us.
Jim, it's always a pleasure. Thank you for calling me up.
My guest has been Victor Adair, co-founder of the Polar Futures Group. His website, polarfuturesgroup.com. You're listening to HowStreet.com radio. Any questions for our guests or the show can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.